Okay guys, another tutorial. This tutorial is about, let's say, it's an introduction concerning bonds, and here we see in front of us a bond, a very old-fashioned bond, a municipal bond, let's say, issued by the state of California. And what do we see? Actually, we should know a bond is just a loan. Only this is somewhat different from your normal, let's say, plain vanilla loan at the bank. This loan you can trade. This loan, let's say, within the maturity of the loan, you can sell to someone else. And what is the structure of this bond? For instance, it is a loan. It's a loan to the state of California of $1,000. And usually on loans, like on normal loans, you pay interest rates. And the interest rates now you pay on this loan are called coupons. And let's say this is called the mantle. And here we see, let's say at the bottom, we see coupons. And it used to be that you go, for instance, to the bank, or let's say to any other government agency, and they cut off, let's say, this part, the coupon of this bond, and then you would get your interest rate on the bond. For instance, if this was this is, let's say, a bond with a long maturity, and they, for instance, cut off, and then you get your 6% or 3%, whatever the percentage may be on the loan. So let's say the structure of a bond is that you have a loan, for instance, with the issuer, and the issuer promised to pay you, for instance, each year an interest rate, which is called a coupon. And in the end, they give you the money back, which we call the face value. They give you the face value of the mantle, of the principal back. So this is the structure of a bond. And it has a specific feature that it's tradable on markets. So with normal loans, you just cannot sell them to, for instance, to your neighbor, while a bond you can. Another feature is, let's say, for instance, we talked about in previous lectures about mortgages. Now, for instance, if you want to buy a house of $300,000 or euros, you cannot issue a bond. And you say, okay, I just issue 300 bonds, and then I have my house, because then I have the 300,000. Usually bonds are issued if you need large sums of money. For instance, the state of California needed 100 million. So they issue a bond, so they divide this up, this 100 million, in small pieces of 1,000, and they sell it to the public. So for instance, in this case, if you need 100 million and you slice it up in small pieces of 1,000, you need to sell 100,000 bonds. This is how it works. And usually banks, let's say, guide this process, this roadshow of issuing bonds. But you don't lend it, let's say, with one lender, for instance, right? So this is, let's say, the prime feature of a bond. And here we see a very old-fashioned bond. Let's say usually these things are not made anymore, but this is how it works. So you get back at the end of the maturity, or at the end of the loan, your money, the $1,000, and each year or each semi-year, depends when they pay the coupon, you get the coupons, and you could cut this off and hand it over to the guy at the counter at the bank, and you get your interest rate, your coupon. So this is, let's say, a normal bond. Now let's try to value this.